Hey guys, how you doing? So Dan from Trading with Dan here. So this is the popular candle pattern section of our mentoring program. So the first candle we're going to look at is called a bullish engulfing candle. So I mean, very simply, just by looking at it, you can see we've got this big green candle that fully engulfs the body of the previous candles. So the previous red candle, we fully engulfed it. That's why it's called a bullish engulfing candle. So yeah, this pattern occurs when a strong bullish candle rises beyond the entire body of a bearish candle, which would engulf the bearish candle's entire body if they were lined up together. So sort of like if you put it on top of it, then it would be completely gone. So you wouldn't see any more of the red body of the candlestick. So this candlestick pattern typically leads to a bullish movement in price action. So the opposite of that here, as you can see, is a bearish engulfing candle, which is literally just the exact opposite. So we've got a big red candle. So if you sort of superimposed it on top of it, it would fully cover all of the green, and that's why it's called a bearish engulfing candle. So this type of candle, candlestick pattern, often leads to a bearish movement in the price action. So a tweezer top. A tweezer top is a double candlestick pattern that occurs when two candles make the same high directly next to one another. This candle pattern typically leads to a bearish movement in price action. So yeah, as you can see, we moved up, price moved up, came back down again, and then price moved up, came back down again, and closed at the bottom. So pretty much the same height. And yeah, I mean, this is what we looked at in the last one. These are wicks again that we looked at. So bearish wicks because they got rejected, the price did, and then these are often will lead to bearish price action, as we obviously know. So again, the opposite, the tweezer bottom. So this is pretty much the same, but obviously the direct opposite. So we were moving down here. You can see we opened here, and then we closed down here. So we had a red candle, and then we moved down here in the meantime, moved back up, and then the next one. So we opened here. We moved down and then closed back up again. So this is called a tweezer bottom. Okay, we can see the two wicks down here, and we know that wicks are a sign of rejection of the bearish price action. So it shows that there's more supply than there's basically more people wanting to buy than there are people wanting to sell there. So this pattern will typically lead to bullish price movement afterwards. So a doji candlestick. A doji candlestick is this one here. So we get the small body that doesn't really opens and closes roughly around the same place. I mean, this can be green. We could open here and then close there and it would be green. But either way, we're opening and closing roughly around the same area, and then we've got a big wick on either end. So a doji candlestick occurs when the price closes near the high, near the open of the candle, with both the upper and lower wicks of a similar length, often referred to as an indecision candle. This pattern often leads to a trend reversal or consolidation. So yeah, I mean, you can see it's indecision. The market doesn't know. It goes up, it gets rejected. It goes down, it gets rejected. And yeah, so like if you assume you've got a trend, so this indecision can indicate that we're going to have either a trend reversal or just a period of consolidation, which obviously isn't the same trend then. So if we've been moving down and we have consolidation, then we stop moving down. So either way, it's sort of a signal that something different is going to happen. The market's deciding what it's going to do. So a shooting star candlestick. This pattern occurs when the upper wick of the candlestick is greater than the length of the candlestick body. There is typically no lower or only a very small lower wick. Regardless of whether the candlestick closes bearish red or bullish green, this typically leads to a bearish trend. So, I mean, again, we can see the candlestick opened here. We moved all the way up, and then we got rejected and we came down. So the wick was longer than the rest of the body. And again, we know this to be a sign of rejection. So it's a bearish indication because price couldn't stay up there and it got sold down pretty quick. And yeah, this often leads to a bearish trend. So I mean, this candle could have opened here, traded up there, then closed down here, and then it would be red, but it would still be the same shape, and it would be the same it would mean the same thing, that we are potentially having a bearish trend. So here we go for the opposite. The opposite is called a hammer. So a hammer candlestick occurs when the lower wick of the candle is greater in length than the candlestick body. there's typically no or only a very small upper wick, and regardless of the candlestick closes bearish, red or bullish green, this typically leads to a bullish trend. So again, we know this, the wick at the bottom shows that price didn't want to stay down there and got bought back up. So this obviously opened here. We potentially traded down here, move back up and close there. I mean, obviously we could open here, trade up there, move down there, and then move all the way back up again. But that's less likely to have happened. But equally could have happened and the candlestick would look the same. Or we could have opened here, traded down here, and then got all the way back up and then closed here, and that would still be a bullish hammer, but the candle would actually be red. But we would have closed here, but the long wick again shows rejection, and it would still typically lead to bullish price action. So the morning star, this is a triple candlestick pattern that occurs in a downtrend as the bearish candle is printed, followed by a doji indecision candle, further followed by a bullish engulfing candle, and leads to a bullish trend. So what we've got is we've got the bearish candle here. We've sort of got an indecision candle. This is not actually a doji candle, but it's an indecision candle. It's not really moved much. It's got a bit of a wick. And then we have this engulfing candle that engulfs this candle here before it. So the whole of this body would cover the whole of this body. And this typically leads to a bullish trend. So the opposite of a morning star is an evening star. So this is a triple candlestick formation, and it is basically opposite. So we've got the bullish candle here, we've got the sort of doji indecision candle here, and then we have this big red bullish engulfing candle which engulfs the whole of this candle here beforehand, and this typically leads to a bearish trend. So yeah, that's some important candlestick formations and types that we've looked at, and obviously that combined with our previous video on what wicks are, how they're formed, and what they kind of tell us, that should give us a good idea on how to observe a chart based on candlesticks. So thanks for listening, guys, and I'll speak to you on the next.